SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to this annual SUERF lecture. Central banks are principally there to deal with price stability, and their other targets are typically not added, with the exception of a few central banks. But in this work, what they're doing is they have to defend the currency, they have to extend their instruments to unconventional policies there. And these unconventional policies have led in recent years to major deficits. And these deficits were created while at the beginning by unconventional policies, a lot of assets were purchased by central banks in order to offer liquidity to calm the markets. And with this happening, also quite likely inflation was created. And how much these assets were due to the recent inflation would be a separate topic, which we don't enter today, but an importance to keep it on the sidelines. This is something where the BIS has recently written against about it, and I also like to comment on that. But the most critical question, what has happened is that while purchasing these assets, in many cases at negative prices, and keeping them to redemption, why this has happened, another thing has emerged. This is inflation, which required that central banks increase their policy interest rates. And this policy interest rates then led that to the fact that banks which have purchased these assets had their liquidity then on the liability side. So an asset-liability mismatch emerged. The assets with no or little rewards, whereas on the liability side one had to spend a lot of resources, expenditures for financing these liabilities. And the result of it, many, not all countries had to come up with negative losses and in the recent balance sheets. And quite likely these losses are going to hang on for some time. For the Austrian Central Bank, our estimates show that before we become positive again, a few years, perhaps even a decade will pass before we become positive. Then we have to pay back the accumulated negative assets there before, positive assets emerge. And at the end, we will still need a few more years before we build up reserves. All this may take 1 or 2 or even more decades before we are back again. Now, central banks are not normal enterprises. And the result of it, if and as the balance sheet becomes negative, compared to a central bank, they don't have to declare bankruptcy. However, what it also means is that central banks cannot simply assume that they can increase their negative equity capital without any kind of limits, because their credibility may not allow it. And so from a perspective of monetary policy, having a central bank which accumulates for many years, perhaps a decade, negative equity may risk their reputation. Now, the question is how to get out of it, and the question is also what to do with it. And typically, this would be a discussion within central banks, but in order to get their guidance, to get perhaps new ideas, it is important to bring researchers, prominent researchers that have worked on this topic for decades, together with practitioners from central banks. And for this reason, we're very happy that we brought a very prominent panel together. On the one hand, Martin Hellwig, formerly at the Max Planck Institute for Research in Collective Goods. He studied, got his diploma in Germany before he did his PhD in MIT and before he became professor across the world. And one of these topics was also always to look at the central bank not only from a pure monetary policy point of view, but bringing to the table, if you want so, the microeconomics of balance sheet consideration with monetary policy. And he did it in a way which I think is still unmatched, and for this reason we're very happy that he accepted our invitation. On the other hand, we have two outstanding, if you want so, practitioners that followed our invitation, which is Sarah Bell and Stefan Ingves. Mrs. Bell, she is head of the Central Banking Studies of the Bank for International Settlement, and in this institution, linking central bank policy with innovative thinking has been a trademark up to now, so very happy that you have you here. And on the other hand, we have Stefan Ingves, the former head of the Central Bank of Sweden, one of the longest serving central bankers, and somebody I admire deeply, and also with a little bit of jealousy about the depths of experience he has. He was also chairperson of the Basel Committee on Banking Supervision, and in this and many other incarnations, he could talk a half an hour about his incarnation. We're happy to have him here. So what this promises is a very interesting and rich afternoon, which will consist of two parts. Part number one is that Professor Hellwig will talk for about 20 minutes, and then we will offer the opportunity for direct questions to him. And then, not to say we change place, Mr. Gnan will come up here and will chair the panel. Then, without further ado now, may I ask you, Professor Hellwig, to take the floor.
Thank you very much for the invitation and for this kind introduction. I hope you won't rue the invitation, because from some words you said, I gather that there may be grounds for disagreement. Monetary policy and the business of the central bank. We have forgotten that central banks are businesses. And that's really the main topic of this lecture. So in 2023, the Austrian National Bank had a loss of more than 2 billion euro. The Bundesbank had a loss of more than 23 billion euro, which was mainly hidden through the dissolution of provisions and reserves. But actually, some people have argued that the loss should have been much larger if only they had applied mark-to-market accounting to the securities they held. 23 billion is a large number. It's a little less than a third of the total losses of German taxpayers from supporting private banks in the 2008 crisis. And it exceeds many of the numbers about budgetary gaps I read in ongoing budget discussions in Germany, which may lead to the founding of the current coalition. That experience should remind us that central banking is a business. We tend to think of central banks as policy institutions. But that's quite a recent development, comparatively speaking, and we shouldn't be fooled by that. First of all, central banks act through transactions with market participants, securities purchases, loans, and deposit taking. Even relations with other central banks are based on contracts. In any business, risks arise naturally, in particular risks from assets held. And some of the discussions of 10 years ago about the riskiness of government debt purchases, people forgot to mention that the most prominent asset in bank balance sheets of the past, namely reserves of gold, were anything but safe. In recent decades, the business dimension of central banking has been somewhat overlooked. Held to maturity rules for accounting protect the bank from very severe asset reevaluations, as might have bankrupted European central banks if they had been carried out to the full in the 23 balance sheets. Funding risks. Well, the bank can print the stuff that it owes. So there is no funding risk. In Germany, there have been voices linking the current experience of the Bundesbank with the experience of Silicon Valley Bank a year and a half ago. And I heard some overtones of that comparison in your introduction. But of course, the parallel only goes so far. Both Silicon Valley Bank and the members of the ESCB purchased low-yielding government securities for a long time. Both Silicon Valley Bank and members of the ESCB paid high interest on deposits. Well, actually, Silicon Valley Bank didn't pay that much interest. The depositors just ran. And when the ran turned into a panic, they went under. At that time, they were already insolvent. So the narrative, and you could have read this in German papers in the spring, was the Bundesbank is in the same situation as SUB. It acts as a financial intermediary, and it has underestimated the risks inherent in maturity transformation. There's one big difference. Central banks are not forced to pay high interest. If I go back to around 1990, interest rates on long-term securities were on the order of 90% and higher. Interest rates in money markets were between 5 and 10%. Interest rates on banks' reserves with the central bank were at zero. The discrepancy between market rates and this zero was much bigger than it was in 22 or 23. And there was no force compelling central banks to do this. So what has changed? The change has been an introduction of interest on bank reserves as a policy instrument. So one thing to appreciate is this was a conscious policy decision, maybe not fully thought through, but it was not a matter of being forced by markets to move that way. Why? Well, one idea would be that high interest on reserves provides incentives for commercial banks to reduce their own lending and their own creation of bank money. This is why high rates on reserves may contribute to fighting inflation. In a system in which banks needing liquidity loans are balanced by banks holding excess liquidity at the central bank. Extending interest rate policy to reserves as well as to lending facilities may be a way of making these policies altogether more effective. So there has been a good reason for introducing this. Altogether, this described change marks a new turn of the wheel in the history of central banks and their relations with the private sector. Profits and losses all of a sudden matter again. If you go back to the origins of central banking, I'm sure Stefan, as former governor of the Riksbank, remembers this from the old times. In the old times, the stuff that central banks issued was debt. And insolvency or illiquidity was a serious existential risk for a central bank. The note issue was a promise to pay gold. In one case, the Bank of England, this was after the Battle of Culloden, before the Battle of Culloden. This was in the invasion of the Young Pretender in 1745-46. The Bank of England suffered a run and paid out coin by coin by coin. So after 3 days, they could stop it because the Scots had been repelled and the panic subsided. But that was a sort of innovation for how to deal with the run by just proceeding in a very thorough manner. Even after the abandonment of convertibility in gold, exchange rate regimes imposed constraints on central banks. And any central bank that has experienced a fixed exchange rate regime or the Bretton Woods regime, or even, like in the case of the Austrian National Bank, the regime of tying themselves to the D-mark after the demise of Bretton Woods, will appreciate that these obligations imposed constraints on policies. Monetary policy was for a very long time not a very interesting or meaningful term. It meant management of reserves at interest rates under the gold standard, or it might mean exchange rate policy, or rather management of the monetary system with a view to maintaining exchange rates. But the macro objectives that we've come to think of as being the natural job of a central bank, fight inflation, promote unemployment, have interest rates stable and possibly low. Those are the objectives from the Humphrey-Hawkins bill in the US. Those had not yet appeared. Even so, central banks were special. They had privileges from their governments in the form of being asked to manage government deposits. They had privileges in the form of restraints on the note issue of other banks in various forms. And there were associated mandates, such as lending to government. Then there's low and stable interest rates. That actually appears in the constitution of the Banque de France from the era of Napoleon. They had no exclusive focus on profits. And that was part of the secret of their success. They did not compete with commercial banks in various loan markets. And this was why commercial banks were willing to hold deposits with central banks and entrust the management of their own gold reserves to the central bank, because there was a sense that there wasn't that much competition. And that structure, the central bank acting as the bank of banks, was the basis for Berger's famous dictum: if the private banking system is in a crisis, lend freely to solvent banks at a penalty rate. Against good collateral, where good means at normal market prices, not at panic market prices. Berger's suggestion was actually a suggestion that was good for the profits of the central bank, because that type of intervention, and the Bank of England has shown that on a number of occasions, was helpful, tended to be profitable. I already said no macro mandates, no real policy. Then came the disaster of the Great Depression. In the Great Depression, central banks did not follow Berger. They were always in fear of losing their gold reserves. They were dominated by the gold standard and were in fear of the run. Most prominently, the Banque de France, the Federal Reserve, and the Riksbank in Germany. The Riksbank in Germany, of course, had serious problems which triggered the banking crisis of 1931, because the run on the Reichsmark meant a run on the Reichsbank's reserves. Interestingly, in connection with the discussion of central bank profits and monetary policy, also in the light of discussions of the past, of 10 years ago, 1931 was a year of extraordinary profitability for the Reichsbank. Why? Because to protect the currency, they had raised interest rates, the interest rates they charged commercial banks, to astronomical level, so they earned a lot of money. And at the end of the year, the government said, it's wonderful you have these profits. We'll use these profits of yours in order to recapitalize the insolvent banks. That banking crisis and the high profits of the Reichsbank also throw aside or throw a light on the relation between monetary policy concerns and the business side of central banking. Now, the big change came in the US in 1933 with the end of convertibility of the dollar in gold. In other countries at various stages until 73, and then in 73 with the end of the Bretton Woods regime of semi-fixed exchange rates. After 73, central banks were issuing pure fiat money, pieces of paper that were not claims to anything. What does that mean from a business perspective? Well, the central bank's note issue is not a debt anymore. Central banks have the note issue as a liability on their balance sheets, but it's a liability that does not commit them to anything. There's no way any holder of central bank money notes could compel the central bank to deliver anything that the person might want. the fact that that the note issue appears as a liability on the balance sheet is purely a convention, a historical tradition. I submit it's a useful one because it makes equity appear smaller than it actually is if you think about the economics of the balance sheet. And that may reduce the temptation to finance ministers and other politicians to get the central bank to pay them more. As I mentioned before, price stability, full employment, macro objectives came in the post-Great Depression era onto the agenda of central banks, and fully after 73, and it was enabled by the fact that with fiat money making up a large part of the liability side of the balance sheet, business risk of the central bank had disappeared. I haven't talked about bank reserves yet. I will get to that in a few minutes. Until bank reserves started to pay interest, they were just like fiat money in the sense that a deposit that a commercial bank held with the central bank was merely a claim to be given notes. And since the production of notes has negligible cost, this didn't really matter for the business position. In the discussions that we had in 2014, 2015, well, actually in Germany it began already earlier, 2012, 2013, there were all these warnings. If the ECB purchases government debt, let alone Greek government debt or Italian government debt, those debtors may not be able or not be willing to pay, and then our central bank will go bust. Now, suppose you ask any money forger, you produce these false bills, use them to buy stocks. Are you better off? Yes. The stocks lose 50% in value. Is that a problem? Well, I'm less happy than I was in between, but it's still no problem. Having 50% of what I purchased for basically nothing is wonderful. The difference between the money forger and the central bank is the central bank does this legally, and the money forger has to fear the police. That was the discussion in 2015. I always wondered why even the president of the Bundesbank refused to sort of follow standard wealth calculations, trying to look behind the balance sheet. In parentheses, I've also been wondering who he was talking to. Was he talking to the Federal Constitutional Court? I'll come back to that. So, the new change is, and I think it's a very fundamental change, that reserves pay interest. And it's not just an epsilon like 0.5%, it's a substantial number. How should we think about it? And this interest is the major cause of today's losses. How should we think about that? It turns out that in the 1960s, there was an extensive theoretical discussion on the subject, driven or induced largely by the proposition of Patinkin, in his book, his very fundamental book, Money, Interest, and Prices, that central bank money is part of society's wealth. Whereby wealth, he means it's something where on aggregate spending behavior reflects these wealth positions. The bills I have in my pockets are part of my wealth. The fact that the Bundesbank, say, has issued these bills is not an obligation on the Bundesbank. If I put the two together, the Bundesbank and me, these bills are part of our aggregate net wealth. That was Patinkin's position, and his argument was important because he suggested that these wealth effects are important for the functioning of the monetary system. The trouble is, this is now for academics, the academics have never learned how to properly deal with Patinkin's propositions. And that's why at some point on the initiative of Michael Woodford, they've said, let's get rid of money altogether. Modern monetary models tend to be models of the unit of account without any physical substance. I think that's a problem because these wealth effects are important. Now, one book in the 60s by Boris Pezek and Thomas Saving, Money, Wealth, and Economic Theory, discussed the issue of interest on central bank money. And they argued that to the extent that central bank money pays interest, it's actually debt. How come it's actually debt? Well, it's a promise to pay something. To pay what? Well, the coupons. Why is that different from the note? The central bank can always create the stuff. So in terms of micro constraints, business constraints on the central bank's behavior, there is nothing more to the payment of interest on notes than to the issue of notes itself. There is a snag with this, which is if the central bank doesn't earn the revenue to cover those interest payments, it must print them, which means an increase in the quantity of central bank money. And although the past 20 years raised lots of questions about this, there's a sort of fundamental belief among economists that if the quantity of central bank money is raised 10% per year, or let me put a more realistic number, 5% per year, that provides 5 percentage points as a component of inflation year per year. So the real problem about paying interest on money is not the micro problem of not having the wherewithal to pay this, but the link between the micro problem and the potential breach of the promise of price stability. A famous paper by Bob Lucas says inflation doesn't work, paying and money is super neutral. Well, in that model of his, money is created by paying interest on outstanding money. Inflation goes in line with the growth in outstanding money, and lo and behold, everything is neutral. In actual practice, we've seen that structural effects and frictions may weaken the causality chains. For instance, it's clear that commercial bank reserve holding behavior and thereby multipliers for bank money creation have changed after the financial crisis and throughout the 2010s. But if the price level mandate is to be maintained over a longer period of time, it seems clear that interest on reserves must be funded by returns on assets or potentially by taxes. Pesek and Saving, whom I quoted, continue saying that to the extent that money is not wealth, it's not really money. And Harry Johnson, in a wonderful paper, said that's just a confusion between marginal benefits and average benefits. This is about marginal benefits from money holdings being close to zero or even zero, but then average benefits may still be positive. All this is very academic, but the point about the payment of interest on money creating a material obligation for the central bank, I think is not academic and is real. Now, at around the same time, Milton Friedman enunciated the so-called theory of the optimum quantity of money. His proposition was, it's wonderful if the central bank creates a real return on the money that it issues. To make it, to put it on a par with the real returns on other assets, such as government bonds or real capital. Because that means that people will expand their demand for money to the point where the marginal benefits from holding it are zero. And since it doesn't cost anything to produce the money, that's efficient. It doesn't cost anything to produce the money? Is that a statement about the printing press? No. Friedman's idea was we can always have a higher real quantity of money in the economy if only prices were a lot lower. And that doesn't impose a material cost. There may be an adjustment problem. But the key point is having incentives for people to hold money makes money more attractive, increases the value, the equilibrium value of money relative to goods and services and the like, lowers the money value of those things. That's wonderful because at that point we'll exhaust all the benefits that we can have. Notice that there's an element of a deflationary impact at the start. In the new regime that Friedman proposes, the value of money will be higher from the very beginning. Transitions may cause a problem. If you look at the experience of the US, in October 2008, Bernanke introduced the payment of interest on bank reserves. And that was a major contributing factor to the freeze of money markets, which haunted the global economy after the Lehman bankruptcy. So the dynamics of all this are perhaps a bit difficult. But I don't want to talk about the dynamics. I wanted to talk about a gap in Friedman's analysis. You might say, central bankers might say, we're just following Friedman. And I'm sure that something like that went through Bernanke's head in 2008. The problem is, Friedman never talked about the funding of those returns. How does the central bank or the government get the resources it needs to create those returns? His analysis is what's called first best optimal taxation analysis. First best meaning if there is a deficit somewhere, you can impose lump sum taxes on everybody, and that covers the deficit. Well, we know that we don't have lump sum taxes. And there is a theory of the second best. The moment you have a second best problem, it's not clear that moving to the no distortion position in one place is the solution to, well, it is in any sense efficient. You get to a trade-off between different distortions. Mind you, this is not a one-time problem. And therefore, discussions of should governments recapitalize central banks are not really appropriate for the problem. As long as you have a regime with interest on reserves above interest on assets, the problem will be there. So it's potentially a permanently pending problem. As such, it imposes huge threats to the independence of central banks. Peter Conti Brown's historical study of the history of the Federal Reserve argues independence of the Fed was guaranteed by one thing and one thing only, and that was its ability to pay for its own budgetary needs. You have lots of independent commissions in the US that find their independence drastically curtailed if Congress decides to cut their budget. The German Constitutional Court, when faced with this issue, would argue that decisions on budgetary matters are in the domain of Parliament, and this is part of the German constitutional identity. So if this is where the ESCB wants to go, bye-bye euro. It's in the interest of central banks to avoid entering into that kind of discussion, especially if you combine it with the notion, I mean, I've already seen articles to that effect, including strong positions taken by Paul de Grauer at the LSE. It's all a huge subsidy to commercial banks, which it is. But just think about the politics of governments being asked, well, the German government being asked to pay the Bundesbank a subsidy of 20 billion in 1 year in order to cover a subsidy to commercial banks. We're back here to the old conflict between monetary policy objectives and business concerns, and we need to rethink the payment of interest on reserves. One way to do this would be to move to two-part tariffs. This is already being done with a zero interest on minimum reserves and the high interest only on excess reserves, except it would be preferable to have minimum reserves nearer to the actual equilibrium level of reserves. The charm of such a scheme would be that the major distributive consequences would be of paying interest on reserves would be avoided, while the incentive effects at the margin could be maintained. This is perhaps an area where some experimentation may be needed, but the sooner the better. Standard impediments against two-part tariffs, such as in competition this will break down, or people will arbitrage around it, do not apply. The central bank has a monopoly, and also if the inframarginal stuff is advantageous to the customers, so much that there will be much less incentive to arbitrage around this. Is zero interest on minimum reserves a form of taxation, as the 60s literature suggested? Well, is interest on excess deposits a subsidy? We can go on discussing that for a long time, but we should appreciate that banks benefit from their relation with the central bank, in particular from the central bank's willingness to provide them with liquidity in a crunch. Banking is a natural monopoly, and the regulation of natural monopolies ordinarily we think of cost coverage as being a sort of basic axiom of regulatory principles. So once we use the parallel with regulated industries, where the issue of profits is also an issue for what pricing schemes are allowed and what are not, it seems clear to me that moving in the direction of two-party tariffs and doing so much more extensively than so far should not be a legal problem, possibly a political problem, but that depends on how strongly the beneficiaries of the subsidy can make themselves heard in public debate.
Thank you very much. May I start out, with Hellwig? The question of digital currency, how much would your consideration change by taking into account in the future not having money in the current form, but having currently money in the digital form? Would this change anything, or would it only, be a renomination? Your analysis would be the same.
The problem is that the term digital currency is not very clear. So let me address the problem in a more simple-minded manner. Let's look at the current system. What have been the threats to the central bank business? If you think, basically the threat is people don't use central bank money anymore. There have been two versions of this. One, in the years before 2008, financial institutions all over the world economized on reserves using interbank markets. Bank reserves were hardly ever above minimum reserves, and even minimum reserves, of course, were minimal at that time. This did not endanger central banks as business units. However, it did bring the frictions inherent in interbank markets. And we saw the breakdown of that mechanism in September 2008, which I'm sure is why Bernanke, at that very time, which was unfortunate as a choice of time, as I explained, but I'm sure that this observation that it would be a good idea to get commercial banks to use central bank reserves for their liquidity management, that was to some extent motivated by the Friedman observation. But, as I was saying before, the extreme situations before did not much endanger the business model of central banks. The key thing has always been the note issue. Now, the note issue has declined, the importance of the note issue has declined relative to other economic variables. Some of that is a secular decline, some of that is has accelerated over the past 15 or so years. That then has to do with the changes in payment customs of ordinary people, and this is where digitization comes in. If you go to, if you relate that observation to your initial question, or rather to your question, if we think of digital money as something that central banks introduce in order to have a substitute for the note issue, that's a way of safeguarding the business model. If you think of central banks, and I've been told that this is the thinking at the ECB, think of digital money, and I've been told that this is thinking at the ECB, as something that you introduce, but you leave it to the commercial banks to manage, which has other advantages, but certainly the profits from that activity will stick with the commercial banks. This is why I was saying before, in using the term digital money, we need to be clear what we are talking about.
Okay, thank you much for this clarification. With this, I hand over to Ernst Gnan.
Thank you very much. We are now going to have two panelists to complement Professor Hellwig's comments. Let me, without further ado, hand over to Sarah Bell from the BIS. Sarah, the floor is yours.
Thank you for the invitation to be here. It's really an honor to be part of this distinguished panel. And thank you for your excellent and thought-provoking remarks earlier. So I'll say a few words really coming from an international perspective, zooming out a bit and not focusing on any particular jurisdiction, also with some graphs to help illustrate the story, and commenting on some of the similarities and differences across central banks and a bit about what may lie ahead. And I should caveat this by saying that these views are my own and not necessarily those of the BIS. So let me reiterate this point that central banks are indeed businesses, but they don't exist as profit-making institutions per se. They're part of the public sector to fulfill their policy objectives, and they remit their excess profits to the fiscal authorities and hence are part of this consolidated public finance sector picture. And they exist fundamentally to preserve trust in money, which is a theme that I'll touch on. And we know from history that profitability or positive central bank equity is neither a necessary nor a sufficient condition for preserving this trust in money. We know this because we've seen several cases where central banks have operated successfully, met their policy objectives with negative equity. In other words, losses do happen at central banks sometimes. This is part of central banking. But it's important to remember that they've also benefited from this support by fiscal authorities with sustainable debt levels. So just to preface with a little bit about different central bank business models, to simplify, I can group into two big groups based on what primarily drives their P&L. So nearly all central banks are making money from seigniorage. This is the net income, of course, earned from currency issuance. It's non-interest-bearing liability, which is a sort of structural income stream that's unique to central banks. But there are important differences in these two groups. So the first group being advanced economy central banks that purchase domestic currency assets or funding for lending schemes, who are now facing either valuation declines on those assets, depending on their accounting treatment, or rising funding costs. So in addition, of course, to the euro area national central banks, this includes the Bank of England, the Fed, the RBA, Reserve Bank of New Zealand, Riksbank. And then there's the second group. And this is the emerging markets and the small open economies that have built up FX reserves to cushion shocks to defend their currency. And as the direction of FX rates and the resulting profit volatility is hard to predict, there's a long history of central banks in this group that have experienced losses and negative equity. So just to mention that the Swiss National Bank is a prominent example in this group, for example, and the strength of the franc, of course, wiping out the distribution reserve such that it didn't transfer any profits in 2022 or 23. But this year it's returned to profitability because of the weakness in the Swiss franc. But the point I want to emphasize is that this profit volatility is a function itself of policy, and that countries with larger FX reserves and a greater capacity to intervene have seen smaller currency depreciations. So coming to the advanced economies, and I think this is a story you know well, but I show some pictures to help a bit. So after the GFC, we know that a number of central banks used asset purchase programs or other lending programs to achieve their macroeconomic and financial stability objectives. Other central banks only introduced these kinds of programs during the pandemic, and the result was this significant balance sheet expansion that you see. The use of the balance sheet essentially transferred the financial risk from the private sector to the public sector, which of course is consistent with the very policy purpose of central banks. And to fund that expansion, as we've heard already, the amount of interest-bearing commercial bank reserves increased as well, reducing the share of interest-free liabilities, i.e. cash and equity. And this funding was inexpensive when interest rates remained low. But then we saw that as inflation spiked, with the recovery from the pandemic, central banks raised their interest rates to tackle inflation, meaning that interest expenses increased significantly and net interest income declined. Asset valuations also declined with rising bond yields, resulting in either unrealized or realized profitability declines, depending on the accounting treatment taken by the central bank. And maybe just a word on the SVB comparison. Yes, this is a demonstration of interest rate risk, but of course, the big difference, I would say, between central banks and SVB is that interest rate risk is endogenous, because central banks are the very public organizations that are determining interest rates themselves for those policy reasons, again. And of course, the risks of maturity transformation are near and dear to my heart, as I was the member of the Secretariat supporting the working group on liquidity when Governor Ingves was chairing the Basel Committee. So I can say that uninsured deposits were something that was discussed in that working group, not necessarily something where there was consensus around. So there's, I think, some footnotes in there, but clearly something that became a big issue in the context of SVB and other regional U.S. banks. So just a comment also on government revenues, because central bank P&L can and does impact government revenues, but it's really important to look at this over the long run. And so in the context of low inflation and low interest rates, bond purchases tended to boost central bank income over the last decade, boosting transfers to those fiscal authorities. And these are just 4 examples, each with very unique aspects. So RBA only introduced unconventional monetary policy measures in March of 2020. The Riksbank had an extra dividend in 2000. But you can see clearly that for the UK, for the US, transfers were exceptionally large in this inter-crisis period. So this is the sort of medium blue color in the middle. And now those transfers will be curtailed, in some cases for years to come, and that will have an impact on government revenues. But the contribution of central banks to government revenues is pretty modest in the grander scheme of things. And I think what this really underscores is that the purpose of central banks is not profits. Seigniorage is a sort of structural side effect of banknote issuance and is not intended to function as a source of profit for the government, per se. So now, moving back to the case of the small open economies and the emerging market economies that have had experiences with negative equity and show that losses don't compromise a central bank's ability to fulfill its mandate. So between 2002 and 2021, about a third of these central banks had experiences of negative equity without an impact on financial and price stability during that period. And the share of FX assets for EME central banks went from 60% in 2000 to over 85% in 2019, meaning that sensitivity to those exchange rate swings was the primary driver of profit volatility through the impact on asset value revaluations. So this shows 3 recent examples of that type. So it shows Chile, Czechia, and Israel. And it shows that even while equity was negative, inflation in these countries remained contained. So the takeaway is that positive central bank capital isn't a necessary condition for preserving price stability, and central banks should be judged on whether they meet their policy objectives. That said, the corollary is that positive central bank capital isn't a sufficient condition either for preserving price stability and trust in money. And in the last decades of the 20th century, we saw trust in fiat money break down in a number of economies, particularly in emerging markets, particularly in Latin America. And here it was the monetization of public debt that drove hyperinflation. So just to summarize, I think what we can learn a little bit is that the sustainable consolidated public finances matter. And in the cases of macroeconomic mismanagement or state institutions that lack credibility, and erosion of the central bank standing can play into that and be a factor in exacerbating deterioration and bringing trust in money to a sort of tipping point. So the ultimate backing for the value of money is the fiscal sustainability of the consolidated financial sector, public sector, that is. And just maybe a word on what happens when central banks face losses. It does depend on the distribution rules that sort of define the relationship between the central bank and the fiscal authority. And different central banks have different forms that this can take on. There's different approaches to defining what excess profits are and how they're distributed. So some central banks, like the Federal Reserve, where I worked for many years, must automatically transfer excess profits to the fiscal authority. Others hold buffers to absorb losses, and these can be either statutory or discretionary. Some have averaging schemes, distribution smoothing mechanisms to reduce volatility of transfers. But whether and how much equity or buffers the central bank holds is fundamentally a kind of political choice. So on the one hand, when huge amounts of equity are sitting at the central bank, it's not being used for other possibly more socially efficient purposes. The pro side, having those buffers there reduces swings in remittances, swings in expectations of politicians, and reducing the frequency of potential negotiation with the fiscal authority that can help ensure that central banks are unconstrained in their focus on their policy objectives. So, there's trade-offs, and it's a question of whether you want to protect the central bank from the sort of 20-year flood or the 100-year flood, but the amount needed to cover risks under all possible circumstances would be massive and impractical, and anyway, large amounts might tempt extraction. So I say that because I think needing periodic fiscal backing doesn't necessarily risk central bank independence. Its existence as a backstop for the central bank is essential, but this can take different forms. So in principle, central banks, and some do, have automatic recapitalization arrangements that are based on certain parameters. Some central banks have explicit indemnities. The advantage of those can be that they make clear that the financial risk of some of these policy measures belongs broadly to the public sector and not only to the central bank, reflecting those ties that I mentioned earlier. And this can be seen as a way to make clear that that fiscal support is there, and that won't constrain policy measures because of financial risks to the central bank. On the other hand, other central banks see indemnities as unnecessary since those links to the public sector balance sheet are already there implicitly. And the worry is that making them explicit may create other risks if they give the impression that the central bank independence could be constrained. But the bottom line is that the ties to the fiscal authority are there, they're necessary, and the key is that they're not manipulated in a way that jeopardizes central bank independence. So when could independence be jeopardized? I think it could happen directly or it could happen indirectly. Directly, it could happen if the government exerts pressure on the central bank and how it pursues its mandates in exchange for recapitalization, which could inhibit then the ability of the central bank to meet its mandate. So the more automatic recapitalization arrangements are, the less likely this is to be the case. And fully automated rules for rebuilding capital through future income streams, for example, take the uncertainty out of the equation. But allowing for capital to rebuild is really just a different form to do it over time rather than an upfront transfer. depending on the jurisdiction, one is more or less feasible or more or less palatable optically. But independence can also be jeopardized in indirect ways. So for example, if a central bank pulls its punches, if it pursues suboptimal policies to avoid losses, for example, or alternative income streams that are inconsistent with their fundamental mandates. I think that could be an indirect way that independence might be jeopardized. And then, of course, there's a scenario of kind of the perfect storm where central bank credibility could erode if the state's credibility is deteriorating as well, or if the fiscal backing is uncertain or macroeconomic prospects very, very bad. And there is also the possibility that misperceptions create reality if public and if stakeholders misunderstand the reasons for those losses and what the impact would be on the central bank, which is, I think, central banks can mitigate this risk, this reputation risk, and it's why it's so important for central banks to communicate clearly on this issue and have a framework for distribution rules and what happens when they face losses. And so far, I don't think this has demonstrated itself to be a major issue in central banks currently facing losses, but this remains to be seen. So just finally a bit on the outlook for central bank finances. So on the interest on reserves, obviously this can take different forms in different central banks, have different approaches to tiering or even whether they require reserves at all. But generally, this is done on the basis of the approach that best supports that central bank's operational framework. So this move from corridor to floor systems for monetary policy implementation is key. And of course, paying interest on reserves, the purpose is to create this floor below money market rates. And people can debate and certainly learn from the experience so far with different approaches. And there's a lot that we don't know about where the stable equilibrium for market liquidity will be. But I think that the key is that those choices are made based on policy objectives. What's the best approach to take to meet your monetary policy mandates? And avoiding losses could be a tertiary consideration, of course, but it's really important, I think, that the focus be on the policy objectives. And then just a word on seigniorage, and certainly we've seen a lot of changes, greater use of digital payments, the entry of fintechs, proliferation of crypto and stable coins. And for many central banks, seigniorage income is still strong. It's not a concern, but for others, cash is declining. And this could call into question whether they need a new income stream or a new funding arrangement and how this could be addressed while preserving central bank independence. To avoid having to go very often, and then there's a question, I think, about what's too often or not, to go to the fiscal authority for a recapitalization. So just to wrap up, central banks fulfill a policy purpose. Sometimes that purpose coincides with profitability, as it has for most of the past decade, even after paying interest on reserves was introduced, but it shouldn't be taken for granted. And taking on financial risks is an inherent part of the role of central banks. But ultimately, it's independent central banks with clear mandates and that solid fiscal backing that can help preserve a stable financial system.
Thank you very much, Sarah. You didn't disappoint. I was counting on the BIS to provide a global overview and to show us data that nobody else has in the world. Thank you very much for supplementing Martin Hellwig's remarks so well. We now turn to the person who has a history of several centuries of central banking behind, as we heard from Governor Holzmann. Stefan, what's your take on the subject?
Well, thank you. Thank you for the introduction. Yes, I come from an institution that has been around since 1668, so we have tried everything in the book and a few more things in addition to that. And some of it worked, some of it did not work at all. So let me say and add my sort of 10 to 15 minutes to this very, very fascinating conversation that it's, on my side, it's both a privilege and it's a joy to have been asked to participate this afternoon. First, listening to Martin Hellwig and also to be on this panel. In my case, I have almost 30 years in central banking, which means that I've dealt with macro, monetary policy, financial stability, macro-prudential policies, payment systems, and the distribution of notes and coins, which is actually, in my corner of the world, the disappearing business, which matters when it comes to seigniorage, or actually in the future, the lack of it, which is one of the subsections of today's conversation. But today's topic is not really about overall macro, nor about monetary policy as such in its purest aggregate form, because that's usually discussing whether the policy rate should go up and down and how much. And over the years, it has struck me as a practitioner how easy it is, particularly if you come from the macro side, to forget about the institutional setup. And institutions, they do matter, and sometimes they matter a lot. And that's why it's really what this is all about, is how you actually execute monetary policy, and how important it is from time to time, and this is why today's session is so fascinating, how you grapple with the details of what I would call the monetary plumbing. And part of my job has always been to deal with the plumbing among plumbers. First, so I'm going to mention 10 different things that really do matter when it comes to dealing with central banking. And some of the 10 things that I mentioned touched on what we already have talked about, and some will be kind of an extension of what matters. First, there are many ways to execute monetary policy, and what is considered to be a good way of executing monetary policy actually changes over time. And just think about the way we have talked about it this afternoon, about different views on the need to have a positive reserve requirement or no reserve requirement at all. And in addition to that, how you best communicate, for example, if you happen to be an inflation targeting central bank. Second, the execution of monetary policy is bound to differ from jurisdiction to jurisdiction. You just cannot compare a country with a few banks and a very small financial market with, let's say, Wall Street. And this is, of course, particularly in the case of the ECB or maybe the ECBS, an additional challenge, because, and not the least in times of difficulties. And because then that means that what happens in different parts of Europe matters for monetary policy and the design of monetary policy for Europe as a whole. Third, there are good times and there are bad times. And in recent memory, many parts of our monetary policy toolkit, and this holds particularly if you happen to be an inflation targeting central bank, those tools were actually developed during what came to go under the heading the Great Moderation. The problem with that was that soon after the Great Moderation, very soon, things actually morphed into the global financial crisis, the euro crisis, too low inflation, the pandemic, and lately war in Ukraine. And that means that the Great Moderation has not returned yet. And that is, of course, a dilemma in itself when we think about monetary policy. Fourth, in normal times, it's possible to conduct monetary policy, particularly if you have credibility, with very, very limited means. It is almost as if it's enough just to do the talking in a press conference. And there is hardly any focus at all on the balance sheet of the central bank. And with enough seigniorage, then you pass on an annual dividend to the finance ministry, and this happens almost with automaticity. And no one really focuses on these issues. But this rests on a very important assumption that you have credibility and that it is understood that if need be, you can always expand the balance sheet of the central bank up to a point where private banks and other market participants have to accept the interest rate level desired by the central bank. And this assumption is actually quite often forgotten when you discuss the technicalities of monetary policy in good times. And a very simple way of expressing this is the way they sometimes talk about this on Wall Street in the US, where they tend to say, don't fight the Fed. That's really the bottom line. Fifth, this story is very different in bad times. Like it or not, in bad times, central banks become lenders of last resort, and nowadays actually also market makers of last resort. And this, in addition to the need to expand the balance sheet, if you happen to be close to or at or maybe slightly below a zero interest rate. And it's under these circumstances a statement, whatever it takes, followed up by action is tested. So just imagine the opposite when you are in dire straits and you say, no, we're done. We don't deal with this problem anymore. I'm convinced that when the cards are called and you do nothing, the economic outcome then would be far worse. But maybe the capital of the central bank stays intact. Sixth, the central bank balance sheet issues have elements in common with how you actually discuss the cost of a banking crisis. In both cases, ex post, a lot of focus tends to be on the accounting cost, which appears easy to measure at a given moment of time, and it's difficult actually to compare apples and bananas. And let me explain. The accounting cost, that's one thing. The loss of output, increased unemployment, and an inflation rate off target, that actually represents the real cost to society of doing too little or nothing at all. In addition, if the general level of interest rates is lower due to central bank measures, then the accounting gain from those policies shows up on accounts outside the balance sheet of the central bank, and often there is a low willingness to calculate that because it's hard to do, and the focus on the net result for society as a whole tends to be discussed somewhere in the shadows. But this is, of course, the ultimate target of what the policy objective of the central bank is. And here, central banks do have a pedagogical dilemma, and they need to persistently explain the societal role of the central bank and contrary to the role of private banks. Now, seventh, and this is without getting into any of the technicalities, it's not trivial what accounting rules you use when you present and discuss the profit and loss of a central bank. Since central banks in most cases are forever and they cannot go bankrupt in a legal sense, what is a reasonable time period when it comes to the profits of a central bank? How should I measure the different balance sheet items? Should I mark everything to market? Or the other opposite, use rules dealing with holding everything to maturity? And different central banks in different parts of the world, they actually do this in different ways, which makes it difficult to compare different balance sheets. On the one hand, if everything is marked to market, losses or gains for that matter show up immediately. On the other hand, if hold to maturity happens to be the rule, losses come gradually. And then in addition to that, to complicate matters, in an ECBS setting, we live in a half world where the revaluation accounts is a kind of a semi or half equity. And that adds actually to the complexity when it comes to truly understanding what is going on. And add to this, and this holds particularly in small, very open economies, how do you look at gold holdings? And how do you look at FX reserves? And the latter is, of course, particularly very, very important, both in cases that we just heard, when the currency appreciates, but also as well when the currency depreciates. In my view, regardless of the technicalities and what you choose to do, I think that maximum transparency in combination with high pedagogical skills is very important here on the side of the central banks. Or to put it bluntly, if you do not mark to market, somebody else will do it for you. And if you refuse to answer questions, then eventually you will lose credibility. 8. In other papers and in other fora, Martin Hellwig has many times pointed out that there is an interdependency between monetary policy and financial stability. And I very much agree. And during my entire tenure as a central banker, this has been a recurring and a difficult issue, because some may argue that financial stability is for others to deal with. But in my view, that does not hold up to scrutiny, because without financial stability, you run the risk of actually losing the transmission mechanism, which in a bad scenario, of course, renders monetary policy impossible. And I think it's sad that we still struggle with this issue, both regarding the institutional setup and the proper policy combination. And one difficulty is the different time perspective. And let me exaggerate here a bit. Monetary projections usually at the most go, say, 3 years out, while oversimplified, it takes about 3 to 5 years or more to destroy a good private bank. And already this makes it difficult when you try to discuss financial stability and monetary policy at the same time. Now, in ninth, a halfway house between fiscal, financial stability, and monetary policy is what nowadays goes under the heading of macroprudential policies. And a very, very simple way of explaining macroprudential is to say that it's a way to raise the policy rate without raising the policy rate. For this to work, one has to assume that there is not perfect arbitrage between different segments of the financial sector. And we still do not know what the proper combination of macroprudential and monetary policy is. One is specific, and the other one is general. Or to use the words of Jeremy Stein, monetary policy gets into all the cracks, which is the opposite of the way we have designed macroprudential policies. 10th, during my many years of work with the European Systemic Risk Board, I will never forget a board meeting when Martin Hellwig, with super sharp logic, refuted a variety of political arguments about being nice to banks, private banks, that is. That dress down I will never forget. Thank you, Martin. Thank you.
Thank you very much for this brilliant first round of comments. I think it would be best if we offered the possibility straight away for comments. So I noted that Martin took lots of notes, so I think you might have quite a few answers to the various comments. Let's start with you, Martin, please.
Thank you very much. The significant difference between what Sarah was talking about and what I was talking about. I was talking about a mechanism that's inherently deficitary and poses long-run problems. I have no problems with the notion that banks can operate with negative equity. But banks cannot go to the government year by year and say, we've got so much of a deficit, you've got to cover it. The balance sheet expansion has meant that central banks assume lots of macro risks, most macro risks in the economy, and micro risks. At some conference, I believe it was Chicago Fed IMF in 2011, I was reporting on Friedman's proposal and precisely the things I've talked about here, with a statement saying, if this really were to be implemented, central banks would have to be afraid of becoming like the stupid bankers in Düsseldorf in Michael Lewis's book, The Big Short. I.e., they get the rights, the claims on the real assets, and the commercial banks who should have been or should be in charge of sorting out what are good investments and what are bad investments, say, oh, central bank is going to get anyone. So when we do talk about changing these aggregate relations, we need to keep that kind of moral hazard in mind. And you say the interest rate risk is endogenous because it's subject to the central bank's own policies. That's a very dangerous proposition. One version in which I could see this being handled is a German ordoliberal ideologue in 2015 saying, we must not run this interest rate risk by investing in all these low-interest assets. Another version is somebody on the governing board saying in 22, or on the board of, well, take the governing board of the ECB, we must not raise interest rates because that will cause us all to make losses. I mean, the moment we think about interest rates risk being endogenous, we are already on the path to giving at least halfway priority to the economic concerns of the institution as opposed to the policy matters. I share your view that the policy matters should have priority, but history teaches us that this is not always feasible, and I think we need to be careful about feasibility. On Stefan, I have only one point on which I want to elaborate. It's not the last one. It's the transmission mechanism. If we ask ourselves what really happened in the European monetary and financial system in 2008, one answer must be that the collapse in the fall of 2008 led to a disability of interbank markets, money markets, to act as a tool of monetary policy. In the first decade of the euro, with actually quantitative allotments to individual banks, any misallotments were handled by the markets. But the markets drove a large stream of funds going from north to south. With the breakdown of interbank markets in September 2008, the full introduction of the full allotment rule by the ECB, basically the European system of central banks took over that role from the interbank market. At the greater, here I get back to the topic that I discussed, the greater the incentives are for individual commercial banks to hold reserves with individual commercial banks to hold reserves with the central banks, the more this substitution of money markets by the central banking system continues. And we know, of course, that this substitution has played a role in many of the contentious disputes of 2014, 2015. So I definitely think that this is tremendously important. I also think that the ECB had better think about the status quo in that respect.
I think we agree on the fact that central banks shouldn't be going to the fiscal authority year after year with hat in hand. For sure, that's something that's to be avoided. I think my point is at the other end of the spectrum that we can't expect that to never happen either. And so, I think consideration should be given to what's a sort of approximate frequency that would potentially be comfortable, and then making sure that that timeline around that is not driven, by political cycles and not politicized as much as possible. But it's not clear to me that paying interest on reserves necessarily would lead to having to do that, just because of the precise circumstances from this particular spike in inflation in the context of a very large balance sheet after a pandemic. And then, yes, I think it was my point that policy should be the priority precisely so that there isn't anybody saying, oh, don't raise rates because you'll face losses. So I think there's a little bit of a chicken and egg thing there, because in a way, you might always have that. There are always going to be some of those who are worried about central bank losses, who maybe don't understand the full context that they're in. And so the feasibility, I suppose, of prioritizing policy is something I think central banks have to kind of underscore to make sure that they're always in a position to make policy choices for policy objectives first and foremost. But yeah, this is maybe two sides of the same coin.
Thank you, Sarah. Stefan.
I mean, yes, it's a relevant point to sort of think about what happens if you have very large deposits, very, very large deposits with the central bank, and you pay interest on those reserves, because eventually in a bad scenario you run the risk of having the system exploding. The hard part is, of course, given, if I call it the irregularities in our economies, because once in a while a black swan comes flying, and that is essentially a non-insurable event, a banking crisis, a fiscal crisis, God knows what. And somebody has to take care of that in one way or the other. And usually it ends up being the central bank. Ex post, we can always argue whether it would have been better to have done it more on the fiscal side and less on the monetary side. But it just happened the way it happened. And the hard part is really, to Martin's point, is that how do you then return to what's your vision of the optimal combination of central bank money and private sector money? And that relates exactly to Martin's point about the money market. And how do you, when one of those uninsurable events have happened, how do you work yourself towards a vision of a new equilibrium in normal times? And my sort of introductory remarks was essentially saying that we still hope for those normal times, but then something abnormal seems to happen all the time, and we have to deal with that as best as we can. Since I have the floor, and there's been a few sort of words here about central bank digital currencies, it's not the form of money that matters, because there's almost nothing new under the sun when it comes to money. So it's not the difference between paper money or the digital money. It's really our thinking about what is the role of the central bank and what is the role of the private sector that matters. Because IT people tend to sort of get worked up about these things, thinking that we have cooked up something wonderfully new. But since there's nothing new under the sun when it comes to monies, using the plural, it's really our thinking, our conceptual thinking about these things that matters. And let me add one more, and this is a value judgment on my side, setting aside all these other things that we have talked about here today. Ultimately, I think at the end of the day, it's a value judgment to what extent it should be or shouldn't be possible for the general public to hold central bank money. And either you come to the conclusion, which happened in most countries in the late 1800s or early 1900s, that was really what we wanted in our types of economies, or you come to the opposite conclusion that it should be impossible for the general public to hold central bank money, so that you can only hold private bank money. And if history gives us any guidance, those systems tend to collapse sooner or later, because we have problems in the banking sector. But that is a different topic. Thank you.
Thank you very much. I would now like to open the floor for questions that might come from the audience. Yes, please. Thomas Uhl from the WIFO.
Thomas Uhl, WIFO. I want to address a question to Professor Hellwig. You mentioned that the central banks have overtook the interbank market. And I wanted to ask you whether you see the surpluses and deficits in the target system as a consequence of the central banks overtaking the interbank market, and whether you see any implications for the business of central banking from these target balances. Thank you.
Governor Holzmann.
What I was astonished is that this whole discussion did not at once mention that with the event of unconventional monetary policy, some of the thinking or past thinking may not be fully applicable anymore because we're in a different regime now. If and as we will likely, if we stay in this regime, to have a continued development between, on the one hand, asset purchases will continue, and also then this kind of yo-yo between advantages for the government. Because what has happened during this period, government could indebt themselves for close to no money. If you compare this with the interest rate debate before, they made a huge gain. At least this is what I tried to explain the Minister of Finance. Listen, you know, we saved you 70 billion, so what's a few billion here? So I think it's another way of thinking about it, which I think you can make as an argument there. I think that's a critical one. But if it's unconventional monetary policy, then the question is also, as we moved without design from a corridor system to a floor system, this was another step. Now the question is, does it mean we go back again? And this would have a bearing about losses and profits there. And so for me the question is, are we in new regimes, or we have to reflect, or is it all the same? We saw this before, so essentially we can discuss what we discussed before. We didn't mention anything of these elements which are new, at least for me.
Let me propose that I give you a couple of further questions and then we make a final round. Immediately linking to Governor Holzmann's question, I would like to raise the topic of the reversibility or non-reversibility of policy measures. So it seems to me that the far-reaching emergency measures that we have encountered over the, let's say, 10, 15 years, that we are now facing problems of reversibility. We are locked in as central banks, and what the lessons might be for the business of central banks in the future. Should we earlier on think already about how to get out of the regime that we created at a certain point in time? Now, linked to that, Sarah pointed out, and I think nobody disagreed, that policy has always, the mandate, the policy mandate has always priority. And central banks' profit and losses are, not important compared to that. But if I choose an operational framework, and many central banks are now in the process of thinking about operational frameworks for a new normal, whatever that will ever be. But if we think about future operational frameworks, if we have two equally good or three equally good operational frameworks which serve the mandate equally well, and Stefan pointed out that operational frameworks have totally changed over the course of history. There is no best. So if there are several equally good options in terms of policy mandate, might it be a consideration then to choose the one that sustains central banks' finances in the long run, in a structural way? So this was for policy measures, for the technicality of central bank implementation. This links then to a question that maybe Sarah might be able to answer, but all of you might have an idea on this, a structural funding model for the future. So if cash declines, as many people assume, and if CBDC is not created in a way that replaces the seigniorage income, then what should be the business model for central banks so that they don't need to take the hat to governments, as you pointed it, every 2 years or every 5 years? And then a final question linked to this. I mean, Sarah implied that central banks need to ask for replenishment. But to me, this is not so clear. To me, there seem to be three options if a central bank has substantial losses in negative equity. Well, it can be recapitalized, as you pointed out. It can just wait, as the governor pointed out, maybe for 10 years, for I don't know for how long, until future profits replenish the capital sufficiently to turn it positive again? So just wait? Or can a central bank simply permanently ignore negative equity capital? So I think we have sufficient food for thought, and I would like you to pick whatever questions you find suitable for you. Maybe I'll start again with Martin.
I'll begin with Governor Holzmann's first question, unconventional monetary policy. What's been called unconventional was part of the holy triad of monetary policy in undergraduate teaching in the 60s. Open market operations, discounts, and lending. It was only through the 90s development, which shifted everything on the management of commercial banks' liquidity, that open market operations as a traditional mode of funding of a central bank was forgotten. Of course, it's wonderful if you forget things, then you can reinvent them. It's testimony to people's creativity. The key question was about 2015 was not so much a shift to quantitative easing, but the dimensions and the speed. Now, I quite agree that from the perspective of commercial banks, this shift was actually a disaster because it meant that the central bank became a competitor in maturity transformation. And this was one reason why European banks were weak on profits throughout the 2010s and remained weak on profits. When I made this point at the ESRB, nobody wanted to listen. Structural funding model for central banks' equity replenishment. First, the problem I talked about was not a problem of missing equity. I mentioned initially that in principle we could think of the whole note issue as being equity because it's a right-hand side balance sheet entry without any obligation. So the question of what's the side of equity is irrelevant. The real question is to what extent the obligation to pay interest, i.e. to inject liquidity without withdrawing liquidity through the profits you make on your assets to the same amounts, to what extent that risks a violation of the price stability breach. This has nothing to do with equity. It's just about the fact that the promise to pay interest that you don't earn is in itself prima facie inflationary, and one needs to think about this. Structural funding model, already the central bank as a bank of banks is so important. And that will not disappear with digitization. I'm sure there must be ways to introduce digitization in a context in which central banks still earn their profits. On the question of trade-offs, you said everybody shared the view that policy objectives must be given preference. I only do so with the constraint that the commercial viability, the business viability of the central bank must be kept in mind. I mean, you could pursue objectives subject to constraints, but that sometimes requires people to consider the constraints.
I'll come back to this question of whether or not we're sort of in a new regime, and maybe say that I'm not sure that we know yet. And I think this ties to the point earlier that, we keep thinking that things are going to get back to normal, and then something wild happens that we've never seen before in our lifetime. So, I think it remains to be seen. So perhaps we have to assume that we're in a new regime and that things will not work in the way that they did before, and think about it that way. But I don't think that means that we're locked in any way to new operational models. I think that was those have been very much a part of a choice, part of reviews and intensive discussions and things like this. Which isn't to say that they'll be that way forever, because of course these discussions happen as things change, and can be revisited and can be tweaked or even reverted. But I think and there's loads and loads and loads of analysis about the pros and cons of floors versus corridors. So I won't regurgitate in any of that. But I think these are the merits that have been and will continue to be debated and explored. In terms of the structural financing fund model for the future, I think it really depends on the central bank and what is within its mandate. So I agree. I think that CBDC, if it's considered as a substitute for banknotes, can be structured in a way that can be a source of seigniorage income in the future. There can also potentially be other sources that could be explored. Fees for services, supervisory institution fees, that kind of thing. But I do think what's most important there is that each central bank has a different mandate or a set of mandates and objectives, and those kind of other sources of income have to be considered within that context. What are the kinds of things that fit within their mandate squarely? Because the last thing we want is for central banks to become a pure business hedge fund or what have you, just because they have a large balance sheet, for example. And then, I think on the capital question and taken the point, of course, that what your point is really about the long-term kind of interest on reserves model. But I think this choice between asking for a recapitalization or waiting, it's one of these jurisdictional specific issues that the answer is going to be different. The U.S. takes this deferred asset approach where they wait until it builds up again before continuing to remit anything. Versus I think there's in some ways that's a little bit optically easier to do than asking for a recapitalization, but others have kind of foundational institutional regimes that require them to have a certain level of capital. So it's probably not worth trying to change that when you're midstream, which I think, by the way, is true for the accounting treatment as well. And sometimes I get asked, what's the best accounting treatment? And I think it's probably the one you're in already, because it's really hard to change in the middle of when you're going through something as difficult as what many central banks are going through now. So
a couple of remarks then. First, is it possible to reverse policy measures? And my answer to that question is yes. It's not hard to do. You just decide that that's what you want to do, and then you do it. And then you communicate accordingly. And you do it in an orderly and gradual fashion, and then that's probably not so hard to do. The other one, which framework, if you have a choice between equal frameworks in terms of achieving your goals, I would say go for whichever framework produces the most money for the central bank. And that's because then you don't have to go back to Parliament or the finance ministry or whoever you have to talk to constantly about that. And that should also, that rule ideally should be understood by whoever happens to be the finance minister. Because it cannot be a bad idea if you are the finance minister to realize that there is a war chest over in that corner. And you shouldn't touch it too often, because then the central bank can actually handle some pretty bad events and issues that you otherwise would have to handle yourself as a finance minister. But given the short time frame that politicians usually use. It's rare to find a finance minister with that way of thinking. On the issue of negative equity, and particularly in a small open economy, I think that that's a bad idea if you can avoid it, because that leads potentially to a situation where you annually or more often than that have to discuss what the central bank actually looks like, and then again it would be better off if you have positive equity. And I can't see that that's so much of a fiscal issue in the long run, because essentially we're talking about recapitalizing the central bank in such a way that it makes money. And when it makes money, part of that money flow is actually going to flow back to the finance ministry in one form or the other. So if you can calculate net present value, it shouldn't be all that much of an issue. But then that's, of course, setting aside all the political arguments of it. Sarah, you pointed out that it's helpful if you have a legal framework such that you recapitalize the central bank automatically. The Riksbank actually had such a legal framework that very recently came into effect. And immediately when the parliament realized that that was the case, they decided to change the framework. And the Riksbank actually wrote to Parliament saying that we need to be recapitalized by 40 billion, and Parliament came back and said 20 is enough. And so you never really know. But they did one thing which I think is pretty unique. They also said that we have realized that the central bank is not making any money. So could you please come back with a suggested way of basically de facto taxing the banks, which basically would be not to remunerate all reserves. And then at least you would make some money. It's also important to stress that particularly in poorer countries in the developing world, actually a high non-remunerated reserve ratio is very often the only way of taxing, because that's the only way of actually making some money, because you don't have the technical means to force people to pay taxes. Thank you.
Thank you very much. This concludes our SUERF Annual Lecture and our panel on the topic of monetary policy and the business of central banking. I think we really got a good overview of the topic and also diverse views on the many aspects of this topic. Let me give a great thank you to Martin Hellwig for the excellent annual lecture, to Stefan Ingves and Sarah Bell for your really substantial comments and also for the open discussion. And last but not least, to Robert Holzmann and the OeNB for hosting this. So thank you very much.